Welcome to the Skilled MBA Finance Case Study Series, where we decode the decisions that shape successful businesses. In the rolling hills of Virginia, a bold startup is challenging tradition, not through grapes alone, but through numbers. This case study dives deep into the strategic financial planning and capital allocation behind launching a disruptive player in the wine industry. From securing initial funding to scaling operations, every financial move could make or break their future. Will they opt for equity or debt? How will they time investments to match seasonal cash flows? And what trade-offs must they navigate between growth and sustainability? Join us as we explore how financial discipline, market insight, and smart capital decisions could transform this startup into a regional powerhouse. Explore how a startup plans to revolutionize Virginia's wine industry with strategic financial decisions. This case study delves into the pivotal financing choices that determine the success or failure of entrepreneurial ventures in this competitive sector. Commonwealth Crush Common envisions centralized processing facilities, allowing small producers to avoid hefty capital investments. They offer shared storage solutions with temperature-controlled warehousing for aging and inventory management. By pooling resources, smaller wineries can access premium equipment and expertise fractionally. To achieve this, the founders aim to secure 1 crore 66 lakh rupees, United States $2 million, in external capital. Virginia's wine industry, with over 300 vineyards, is expanding yet struggles with scale inefficiencies. Small producers face high equipment costs and seasonal processing challenges. Commonwealth Crush Company seeks to address these by offering centralized processing, shared storage, and resource pooling, enabling smaller wineries to thrive without massive capital investments. CWC faces a financing dilemma, securing 1 crore 66 lakh rupees while maintaining founder control. The choice between equity and debt financing involves balancing ownership dilution against repayment obligations. A critical aspect is determining a fair company valuation to set appropriate equity stakes, ensuring both financial viability and strategic alignment with CWC's growth objectives. Equity financing involves no repayment, but dilutes ownership and may reduce founder control, with investors expecting high returns. Debt financing maintains ownership but requires regular repayments, creating financial risk if revenues falter. Interest payments are tax deductible, but debt may include restrictive covenants. Valuation of CWC involves projecting cash flows over 3 to 5 years, considering realistic market growth. Determine a discount rate, often 25 to 40% for startups, reflecting inherent risks. Estimate terminal value using perpetuity growth or exit multiples. Finally, apply the discount rate to these cash flows to ascertain the present value of the business. The base case financial forecast anticipates initial negative cash flow, with break-even projected by year 3. Revenue and earnings before interest, taxes, depreciation, and amortization are expected to grow as client wineries increase, enhancing free cash flow. This trajectory underscores the importance of strategic growth and client acquisition to achieve financial stability and profitability. Ownership dilution scenarios highlight how higher valuations enable founders to retain more equity. At a 3 crore 32 lakh rupees valuation, founders retain 66.7%, while at 6 crore 64 lakh rupees, they retain 80%. Justifying these valuations to investors is crucial for minimizing equity loss while securing necessary capital. Equity investors often seek rapid growth or early exits, potentially misaligning with founders' long-term visions. While debt preserves ownership, covenants can restrict strategic flexibility. Equity supports aggressive expansion, but debt is constrained by cash flow and assets. Founders must balance control with capital needs to achieve sustainable growth. Creative financing alternatives offer flexibility. Hybrid instruments like convertible notes with valuation caps and revenue-based financing with profit sharing provide tailored solutions. Preferred shares with liquidation preferences ensure investor security. Strategic partnerships, such as wine distribution agreements with upfront payments and equipment vendor financing, enhance capital access while aligning with business goals. Investors in wine industry startups typically expect a 35% internal rate of return, aiming for a 5 to 7 times cash-on-cash return. They anticipate an exit timeline of 5 to 7 years for liquidity events or dividends. Understanding these expectations is crucial for structuring deals that attract capital while safeguarding founder interests. Mastering startup valuation involves understanding discounted cash flow, comparables, and milestone-based methods. Negotiation skills are crucial for structuring terms that protect founders and satisfy investors. Building realistic financial models boosts investor confidence, acknowledging uncertainties. Balancing financial decisions with strategic vision is key to achieving long-term objectives and industry transformation. Commonwealth Crush exemplifies the delicate balance between financial acumen and visionary goals. Their mission to empower local winemakers and transform Virginia's wine industry hinges on strategic capital decisions. This case highlights how entrepreneurial finance directly influences a startup's mission and strategic success. Thank you for watching. Subscribe for more insights on case-based learning and startup strategies. For inquiries, contact us at support@skilledmba.com or visit our website at skilledmba.com.